Hey everyone, welcome back to Boni's Life. I'm Boni, and today we're diving into one of the hottest topics in the financial world right now: AI trading bots. Now, before you click away thinking this is going to be some boring financial lecture, stick with me because this affects all of us, whether you're trading stocks, crypto, or just trying to understand where the markets are heading. Picture this: you wake up, check your phone, and see that your AI trading bot made you $3,000 while you were sleeping. Sounds like a dream, right? Well, that's exactly what thousands of companies are promising you right now. But here's the thing, and this is why I wanted to make this video. The reality is way more complicated than these flashy advertisements make it seem. I've been getting tons of messages from you guys asking about these AI trading systems. Should you invest? Are they legit? Are we looking at the future of trading, or is this just another get rich quick scheme dressed up in fancy technology? Today, we're going to cut through all the noise and get to the truth. And trust me, what I found during my research is going to surprise you. So grab your coffee, hit that subscribe button if you haven't already, and let's figure out together whether AI trading bots are the real deal or just really expensive digital snake oil. Let's start with the big promise. What exactly are these AI trading bots claiming they can do? Well, if you believe the marketing materials, they're basically financial superheroes. They promise to analyze massive amounts of market data faster than any human ever could, identify profitable trading opportunities that we mere mortals would miss, and execute trades with superhuman speed and precision. The appeal is obvious, right? These systems supposedly operate 24/7, never get tired, never get emotional, and never make decisions based on fear or greed. They don't wake up on the wrong side of the bed and decide to revenge trade their way into bankruptcy. They don't panic during market crashes or get overconfident during bull runs. In theory, they're the perfect trader. And here's where it gets really seductive. Many of these companies claim their bots can generate consistent returns regardless of market conditions. Bull market? They've got you covered. Bear market, no problem. Sideways market, that's boring everyone to tears. The AI apparently thrives on that too. It's like having a money printing machine that works in any weather. I've seen advertisements claiming returns of 30, 50, even 100% annually. Some even promise daily profits. One company I looked at claimed their AI could turn $10,000 into $1 million in just 2 years. Now, if that doesn't set off your scam detector, I don't know what will. But here's what makes this particularly tricky. Unlike obvious scams, there is some legitimate technology behind AI trading. Big banks, hedge funds, and institutional investors really do use artificial intelligence and machine learning in their trading operations. So when these retail-focused companies wave around terms like neural networks, deep learning, and algorithmic trading, they're not completely making things up. They're just, let's say, being very creative with how they present the capabilities. The fundamental appeal is that these systems promise to remove human emotion and error from trading while leveraging cutting-edge technology to find opportunities that human traders miss. And honestly, that's not entirely unreasonable as a concept. The problem is in the execution and the promises being made. Now let's talk about the reality check, because this is where things get really interesting. When you look at the performance claims these companies make, you'll notice something. Almost all of them are based on something called backtesting. And this is where we need to have a serious conversation about what that actually means. Backtesting is basically when you take a trading strategy and test it against historical market data to see how it would have performed. It's like saying, if I had bought Apple stock every time it dropped 5% in 2020, how much money would I have made? You run the numbers and boom, you get your results. Here's the problem. Backtesting is notoriously unreliable for predicting future performance. It's like studying for a test when you already know all the answers. Your AI system gets to see all the market data from the past, learn all the patterns, and then show you how brilliantly it would have traded. But the market doesn't repeat itself exactly, and patterns that worked in the past don't always work in the future. This brings us to something called overfitting, which is probably the biggest problem with AI trading systems. Imagine you're trying to predict the weather and you notice that every time your neighbor wears a red shirt, it rains. So you build a weather prediction model based on your neighbor's shirt color. It works perfectly for the data you have, but it's completely useless for actually predicting future weather because the correlation was just a coincidence. AI trading systems can do the same thing with market data. They're incredibly good at finding patterns, even when those patterns are just random noise that happened to occur in the historical data. A system might learn that buying stocks on Tuesdays when the moon is waxing and the S&P 500 opened down 0.3% leads to profits, but that's not a real trading edge. It's just data mining gone wrong. When these systems move from backtesting to live trading, the performance often drops dramatically. I've seen systems that showed 30% annual returns in backtesting struggle to break even in live markets. The difference between backtested performance and real-world results can be shocking. And here's something most companies don't tell you. The live performance data that is available is usually much less impressive than the backtested results. The systems that do provide live performance data often show more modest returns, higher volatility, and periods of significant losses that somehow never appeared in their marketing materials. Funny how that works, right? The transition from backtesting to live trading introduces all sorts of factors that can kill performance: execution costs, slippage, market impact, and the simple fact that markets are constantly evolving. What worked last year might not work this year, and what works with $1,000 might not work with $1 million. Let's pop the hood and look at what's actually running these so-called AI trading systems, because this is where things get really eye-opening. While the marketing materials love to throw around terms like advanced neural networks, deep learning algorithms, and cutting-edge artificial intelligence, the reality is often much more mundane. Here's a dirty little secret of the AI trading world. Many systems that are marketed as revolutionary AI are actually just traditional trading strategies that have been rebranded with fancy terminology. It's like putting racing stripes on your Honda Civic and calling it a Formula One car. The stripes look cool, but they don't actually make your car faster. This practice has become so common that regulators have a name for it: AI washing. It's when companies slap the AI label on basic algorithms to make them sound more sophisticated and charge higher fees. I've seen systems that are essentially just moving average crossovers, a strategy that's been around since the 1960s, being marketed as proprietary AI technology. Now, don't get me wrong, there are some genuinely sophisticated AI trading systems out there. The most advanced ones use techniques like neural networks, reinforcement learning, and ensemble methods to analyze multiple data sources, including price data, volume information, news sentiment, economic indicators, and what's called alternative data. These systems can be incredibly complex and require massive computational resources to run. But here's the thing: these truly sophisticated systems are typically developed by well-funded institutions with teams of PhD researchers, massive computing infrastructure, and access to expensive data sources. They're not the systems being marketed to retail traders for a few $100s a month. The data requirements alone for effective AI trading are staggering. Machine learning algorithms need huge amounts of high-quality relevant data to work properly. And financial market data is particularly tricky because it's what we call non-stationary. meaning the underlying relationships and patterns change over time. It's like trying to learn to drive when the rules of the road keep changing. Most retail AI trading systems simply don't have access to the quality and quantity of data needed to train truly effective AI models. They're working with basic price and volume data that everyone else has access to, trying to find patterns that thousands of other traders and systems are also looking for. The computational requirements for sophisticated AI trading are also substantial. We're talking about real-time data processing, low latency execution infrastructure, and continuous model updating and monitoring. This requires significant investment in hardware, software, and technical expertise that creates barriers to entry for most retail-focused companies. So when you see a company claiming they've cracked the code with their AI trading bot that costs $99 a month, ask yourself, do they really have better technology than Goldman Sachs, Renaissance Technologies, or Two Sigma? Because those firms spend hundreds of millions of dollars on their trading technology and employ some of the smartest people in the world. Now, let's talk about something that doesn't get nearly enough attention in the AI trading world: regulation. And trust me, this is where things get really interesting because regulators are not happy about what they're seeing. The SEC and other regulatory bodies have been cracking down hard on what they call misleading AI claims in the financial industry. Just this year, we've seen multiple enforcement actions against companies that made unsubstantiated claims about their AI capabilities. The regulators are basically saying, if you're going to claim your system uses AI, you better be able to prove it actually does what you say it does. The challenge for regulators is that many AI trading systems operate as what we call black boxes. Even the people who built them sometimes can't explain exactly why the system made a particular trading decision. It's like having an employee who's really good at their job but can never explain their reasoning. That makes it incredibly difficult for regulators to assess whether these systems are operating fairly and legally. In Europe, they are taking an even more aggressive approach with regulations like MiFID II and the proposed AI Act, which would impose specific requirements on AI systems used in financial services. These regulations focus on transparency, risk management, and human oversight requirements that could significantly impact how AI trading systems are developed and deployed. One of the biggest regulatory concerns is the requirement for human oversight and control. Regulators are worried about fully automated systems that operate without meaningful human intervention. But here's the practical problem. How do you provide meaningful human oversight for a system that makes thousands of trading decisions per second based on complex algorithms that even experts struggle to understand? The international coordination required for effective regulation is also a huge challenge. Financial markets are global, but regulation is still largely national. A trading system that's banned in one country can simply move to another jurisdiction with more relaxed rules. It's like playing whack-a-mole on a global scale. What's particularly concerning to regulators is the potential for these systems to manipulate markets or engage in unfair trading practices, either intentionally or accidentally. When you have systems that can execute thousands of trades per second based on complex algorithms, the potential for market manipulation becomes very real, even if it's not intentional. The enforcement actions we've seen so far are just the tip of the iceberg. Regulators are clearly signaling that they're going to be much more aggressive about policing AI claims in the financial industry. If you're thinking about using an AI trading system, you need to understand that the regulatory landscape is changing rapidly, and systems that are legal today might not be legal tomorrow. Now, we need to talk about the dark side of AI trading, and this is probably the most important part of this entire video. Because while individual traders might lose money on a bad AI system, the systemic risks could affect all of us, whether we're using these systems or not. Let's start with flash crashes. Remember the flash crash of 2010 when the Dow Jones dropped almost 1,000 points in minutes before recovering? That was largely caused by algorithmic trading systems interacting in unexpected ways. Now, imagine that happening with thousands of AI trading bots all making decisions at superhuman speed. The potential for market disruption is enormous. Here's what keeps market experts up at night. If multiple AI systems are trained on similar data and use similar algorithms, they might all make the same trading decisions at the same time. It's like having 1,000 people all trying to exit through the same door during a fire. The result can be catastrophic. We've already seen smaller versions of this. In 2020, there were several instances where algorithmic trading systems amplified market volatility during the COVID-19 pandemic. When markets started falling, the algorithms kicked in and accelerated the decline by automatically selling positions. When markets recovered, they amplified the recovery. It's like having a bunch of robots that panic and get euphoric at exactly the same time. The concentration risk is also terrifying. If a significant portion of trading activity becomes dependent on a small number of AI systems or technology providers, what happens when one of those systems fails? We're talking about potential single points of failure that could disrupt entire markets. And here's something that really should concern everyone. The speed at which these systems operate means that market disruptions can happen faster than human operators can respond. By the time a human realizes something is going wrong and tries to intervene, the damage might already be done. We're talking about systems that can execute thousands of trades in the time it takes you to blink. The interaction between AI systems and human traders creates additional complexity. As AI systems become more prevalent, human traders have to adapt their strategies, which can lead to changes in market dynamics that nobody fully understands. It's like introducing a new species into an ecosystem. You never know what the long-term effects will be. There's also the risk of what we call model convergence. If successful AI trading strategies become widely known and adopted, they can stop working because too many people are using them. But the transition period where some systems are still using the old strategies while others have moved on can create significant market instability. Perhaps most concerning is that we're essentially conducting a massive experiment with global financial markets, and we don't really know what the outcome will be. The widespread adoption of AI trading is happening faster than our understanding of its implications. And by the time we figure out the problems, it might be too late to easily fix them. Here's where things get really revealing. Let's look at how the big players actually use AI trading technology, because it's very different from what's being marketed to retail traders. When I researched how major hedge funds, investment banks, and institutional investors actually implement AI trading, I found something fascinating. They're way more cautious and conservative than the retail marketing would have you believe. These institutions have teams of PhD researchers, unlimited budgets, and access to the best technology in the world, yet they still maintain extensive human oversight and treat AI as a tool to enhance human decision-making rather than replace it entirely. Most institutional implementations involve significant human oversight and integration with existing risk management processes. They don't just turn on an AI system and let it trade with no supervision. Instead, they use AI to help with things like execution efficiency, risk management, and identifying potential opportunities that human analysts can then evaluate. The development costs for these institutional systems are staggering. We're talking about investments of tens or hundreds of millions of dollars in technology infrastructure, data acquisition, and specialized personnel. These aren't systems you can build in your garage and sell for $99 a month. What's really telling is that even with all these resources, institutional performance expectations are much more modest than what retail AI trading companies promise. Institutions typically focus on incremental improvements, maybe reducing execution costs by a few basis points or slightly improving risk-adjusted returns. They're not expecting to double their money every year. The risk management frameworks that institutions use for AI trading are incredibly sophisticated. They have multiple layers of risk controls, monitoring systems, and circuit breakers designed to detect and respond to system malfunctions or unexpected behavior. They assume things will go wrong and plan accordingly. Here's what's particularly interesting. Most institutions view AI trading as an evolutionary improvement rather than a revolutionary breakthrough. They're using it to do things they were already doing just slightly better or more efficiently. They're not betting the farm on AI systems because they understand the limitations and risks involved. The contrast with retail marketing is stark. While retail AI trading companies promise revolutionary returns with minimal risk, institutions are implementing these technologies with extensive safeguards and modest expectations. If the technology was as revolutionary as the marketing claims suggest, don't you think the institutions with unlimited resources would be seeing better results? This institutional caution should tell us something important about the realistic potential of AI trading technology. These are organizations with every incentive to maximize returns and access to the best technology available, yet they're approaching AI trading with careful skepticism rather than unbridled enthusiasm. So here's my verdict after diving deep into this world. AI trading technology is neither the revolutionary breakthrough that promoters claim nor the dangerous scam that critics suggest. It's somewhere in the middle, a significant but evolutionary advancement that has real capabilities in specific applications, but also serious limitations and risks. The evidence shows that AI trading technology has achieved meaningful capabilities, particularly in high-frequency trading and pattern recognition tasks. But the revolutionary claims often exceed the empirical evidence and fail to adequately address the substantial risks involved. It's like claiming that because we have self-driving cars that work on highways, we've solved all transportation problems forever. Here's my practical advice for anyone considering AI trading systems. Maintain healthy skepticism about performance claims while remaining open to legitimate benefits that well-implemented systems might provide. If someone is promising you guaranteed returns or claiming the AI has cracked the market, run the other way. Markets don't work that way. And if they did, the person wouldn't be selling you the secret for a monthly subscription fee. If you're going to explore AI trading, treat it like any other investment tool. Do your due diligence, understand the risks, never invest more than you can afford to lose. And remember that past performance doesn't guarantee future results. Look for systems that provide transparent information about their methodology, risk management, and live performance data. Most importantly, remember that there are no shortcuts to successful investing. The fundamentals still matter: diversification, risk management, understanding what you're investing in, and having a long-term perspective. AI trading might be able to help with execution or identify opportunities, but it can't eliminate the fundamental risks of investing. The future of AI trading will likely be shaped by the ongoing tension between innovation and regulation, between performance and stability. The technology will continue to evolve, but so will our understanding of its limitations and risks. The most successful implementations will probably combine AI capabilities with human judgment and oversight rather than pursuing full automation. For now, my advice is to focus on the basics of good investing while keeping an eye on how this technology develops. Don't let fear of missing out drive you to make decisions you'll regret later. The market will still be there tomorrow, and if AI trading technology really does revolutionize investing, you'll have plenty of time to participate once the dust settles and we better understand what works and what doesn't. What do you think? Have you had any experiences with AI trading systems? Are you excited about the potential or worried about the risks? Let me know in the comments below. I read every single one and love hearing your perspectives. If this video helped you understand AI trading better, please give it a thumbs up and consider subscribing to Bony's Life for more deep dives into the topics that matter to your financial future. And remember, the best investment you can make is in your own financial education. Until next time, keep learning, stay skeptical, and invest wisely.